Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting the key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll discuss the ISM services data. In point number 3, we'll take a look at the FOMC meeting notes. And in point number 4, we'll take a look at April 2025 and the overall summary from April 2025. So with that, let's hop right in. And now on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 2.3% growth as of May 8th. Next, each week, we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data fell by 12,000 claims, ending at 228,000, while continuing claims fell as well to 1.879 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement in both the 30-year and 15-year mortgage rates, ending at 6.76% and 5.89%, respectively. Next, we'll look at investor sentiment. One component of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread rose from a negative 33.6% last week to a negative 22.1% this week. Investors are continuing to feel quite bearish with the current market, however, definitely a bit better than last week. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price-to-action relationship to the S&P 500. Now remember, the VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 21.9. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 17.2% probability of a 0.25% decrease and an 82.8% probability of no decrease in June. Mind you, this is down significantly from the previously predicted values of nearly 30%, showing a 0.25% decrease in June. Now, we'll talk more about this data later in the discussion. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 0.19%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 0.96%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was negative 0.05%. Fairly tame week for these market indices, considering the volatility that we've seen over the past month. Now, the biggest winner this week was aggressive growth stocks. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On to point number 2, ISM employment and services data. The latest ISM services report on business for April 2025 showed economic activity in the services sector that continued to expand for the 10th consecutive month. The services PMI registered a 51.6% in April, which is an increase of a 0.8% point from March. This reading indicates expansion for the 56th time in 59 months since June of 2020. The Business Activity Index, which directly factors into the services PMI, registered a 53.7% in April, although this was lower than the March figure. The New Orders Index also showed expansion, recording a 52.3% in April, which was an increase from March. The Employment Index, however, remained in contraction territory for the second straight month, registering a 49%, although this was an increase compared to March. Now, as a quick reminder, contraction is defined by values less than 50, while expansion is a value which is calculated greater than 50%. For this report, 11 services industries reported growth in April, which is a decrease from the 14 industries that reported growth in January and February. Now, these included accommodation and food services, wholesale trade, and healthcare and social assistance. 6 industries reported contraction, such as agriculture, forestry, fishing and hunting, and public administration. Respondents of the survey highlighted several key concerns, with tariffs frequently mentioned due to their actual pricing impacts on small business customers and procurement operations. Uncertainty caused by inconsistent tariff implementation and threats to federal funding programs were also cited as drags on business, and causing some projects to slow or to be delayed. On to point number 3, the FOMC meeting notes. The Federal Reserve recently decided to keep its benchmark interest rates unchanged at the target range of 4.25 to 4.5%. This decision was made as policymakers assess the economic impact of trade policies, specifically tariffs. Although recent indicators suggest the U.S. economy continues to expand at a solid pace with the unemployment rate stabilized at a low level and labor market conditions remaining solid, inflation was noted as remaining somewhat elevated. Federal Chair Jerome Powell highlighted concerns that President Trump's tariffs could potentially lead to higher inflation and unemployment. While consumers and business sentiment have dropped, the full effect of tariffs have yet to appear in concrete economic data. The Fed believes that the risk of both higher inflation and higher unemployment have increased because of the significant uncertainty surrounding the economy's future path under the current trade policies. The central bank is taking a wait-and-see approach. The current interest rate levels offer flexibility to respond to future economic developments. There's also concern about a challenging situation where the Fed's dual mandate goals of low inflation and low unemployment could be in tension, potentially requiring the Fed to prioritize goals that are performing most poorly. All in all, a few key takeaways from the Fed's FOMC meeting this past week, and these are the bullet points that you're seeing on your screen. The current interest rates are set to stay at 4.25% to 4.5%. The real impact of tariffs, as mentioned, has yet to be seen, and thus the decision that the Fed has made to quote-unquote wait and see is being highlighted here. The current projections show 2 possible cuts this year, but with the Fed waiting, this is becoming more uncertain. Risks associated with higher inflation and higher unemployment are becoming more apparent, specifically around with tariffs, And despite the uncertainty, job growth has been holding up. Unemployment is steady, all while inflation is moderating. And on to point number 4, April 2025 summary. April 2025 was one of the most volatile months in history as markets reacted to new tariff announcements. However, even though the S&P 500 fell as much as 12% during the month, the index rebounded and closed within 1% of where it started. Recent data also showed that the economy shrank slightly in the first quarter as companies stockpiled imported goods ahead of new tariffs. While bonds and international stocks were also volatile, both contributed positively to diversified portfolios. This is yet another reminder for the importance of staying invested and diversified in times of uncertainty. So let's talk about some of the key market economic drivers and specifically focusing on what happened in the month of April. The S&P 500 fell by 0.7% in April, and the Dow Jones Industrial Average fell by 3.1%. The Nasdaq rose by 0.9%, and year-to-date, these indices, the S&P 500 has declined by 3.3%, the Dow has declined by 2.52%, and the Nasdaq is down 6.96%. The Bloomberg and U.S. Aggregate Bond Index gained 0.4% in April, and is up 3.2% year to date. The 10-year Treasury yield ended the month at 4.16, but was as low as 3.99% and as high as 4.49% over the month. The US dollar index fell 4.5% to end the month at 99.5, which is near a 3-year low. Bitcoin also during this month fell to 77,000 during the month, but also ended the month at 94,000. The consumer price index rose by 2.4% in March compared to the previous year, slower than expected, and the lowest reading that we had seen since last September. Retail sales fell by 0.9%, including a 1.9% decline in non-store retail sales, which is essentially online shopping. And the household savings rate rose slightly to 4.6%, but is still below a historical average of 6.2%. The economy shrank slightly, with GDP falling 0.3% in the first quarter. And this is the first decline that we've seen since Q1 of 2022, which is a significant increase. What we're seeing is a significant increase in import activity, which has driven this decline. Overall, this led to one of the most volatile months in history, which is a key reminder as to why diversification must be a key component of your strategy. While many sectors fell, bonds and international funds outperformed the rest, even producing overall positive monthly returns as compared to losses. Make sure that you have a well-diversified portfolio so that you can make your goals a reality. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you again for watching. We look forward to seeing you next week.